Good evening and welcome to Mortgage Coffee Talk. My name is Tahir Qureshi. I'm a principal broker of Canada Express Mortgage Inc., license number 13241, and also the host of Mortgage Coffee Talk and Realty Coffee Talk. Tonight we picked up a topic about fixed mortgage versus variable mortgage rate, how to choose. As you understand now, interest rate has gone down another 50 basis point today, as per Bank of Canada announcement. And there are many homeowners seeking renewals, refinancing for their property. And it is very likely that interest rate will go down further in January 25 by the Bank of Canada. So what is the option we have? What is fixed mortgage? What is variable mortgage? And what is the impact of mortgage when you are terminating or selling? Because what happens is during the term of your agreement, if you have lost a job, you don't have income, affordability is a big issue, and you decide that you need to sell your property. Therefore, you have to terminate an agreement depending on the terms of your agreement. So if it's a variable mortgage, is a different terms, payout penalty, and if you have fixed mortgage, the property assessment for interest differential come into picture, and there is a different formula that is used, and we're going to explain this through my presentation. So the idea is to you have understanding of it, what's involved, and without wasting too much time, I'm going to start my presentation. So just stay tuned, and I'm going to put on my screen, and here we go. Start this, and I will lower this one. And where is my here? And we start this here. So the topic is fixed versus variable mortgage, how to choose one. It's sponsored by Canada Express Mortgage. I'm the principal broker of Canada Express Mortgage Inc., license number 13241. And my license is as a principal broker is M08003120. And we're going to do the presentation now. So variable loans. What is a variable loans? Variable interest rate loan is a loan where the interest charges on the outstanding balance fluctuates based on an underlying benchmark or index that periodically changes. For example, anytime Bank of Canada changes the key interest rate, the bank will also change, and there you have a mortgage rate will be adjusted automatically. So this is why the variable has a benefit. It becomes more expensive if the price is going up, interest rate is going up. So the benefit is right now, trend is going up, it's already gone up, now it's going down. So this is a big difference in variable, okay? So when we talk about fixed loan, a fixed loan interest rate loan is one in which the interest rate remains the same throughout the life of the loan. If you sign a 1 year, 2 year, 3 year, 4 year, 5 year mortgage, whatever rate that you agreed, whether it's going up or it's going down, you will pay a fixed amount. You will not change. It will be fixed. So it's very good for those who have fixed income employees. They expect no reduction, increase in income, they don't know, and no extra benefit coming to them from other sources. So it's very important for them to to have a fixed rate, because you have to look at the risk involved with the variable mortgage. What are the benefit to the borrower? So borrower, if variable rate loan benefits the borrowers in a declining interest rate market, because their loan payment will decrease as well. So right now, who have signed the mortgage variable a year ago, now they can see the benefit is coming because their interest rates are coming down. And that is benefit for variable mortgage. Okay. And loan. So what are the pros and cons? So we can look at this. So loan repayment decreases when interest rates fall. So basically, when you are paying a payment, it immediately take it out to the principal. And then you have, every time you are going the payment, your principal is going down. Loans are typically get better upfront perks like low introductory rates for an initial loan period. So sometimes the bank will attract you to give you some special discount, because some variables you can have up to 1% minus. It all depends on your credit, your relationship, and how long you have been a client of a lender, a bank, or whatever. And then those perks will be, some may have to pay prime plus, some may have to pay prime minus. So this is the benefit. The interest rate for a variable mortgage is generally lower than a fixed loan. So if you are fixing loan, interest rate on variable will be lower than the fixed one, especially when the loan is incurred. So when it all depends. So that's why you need to ask the rate. What are the rate for the fixed, and duration of the period that you wanted a loan for? 2-year term, 3-year terms, 1-year term, 2 years term, 5-year term. And amortization is the size when it takes you to pay that. So this is very important for you to ask these questions, and broker will do that. Okay, I think. Okay, now, con. So loan repayment will increase when interest rates rise. So when you are talking about variable, first we have a benefit. Now you can see that if interest rate is going up, you are in trouble. You're going to be paying more money. And loans may become more expensive than fixed rate loans should interest rate rise quickly. And this is what happened last year and in 2023, 24. Interest rate were up. Now it is coming down. But some people who have renewed the mortgage last year, or this year, they have paid more money. But they will benefit if they are in a variable situation. So you have to look. We're going to go through further and explain everything. So borrower face greater risk if overcapitalized or already at a repayment capacity. That means when you have a calculation for variable mortgage, you are paying a principal and you're also paying interest. If interest rate goes up, and then it will trigger a point where you have to pay more money, down payment, to carry on the mortgage, because the entire amount will be going toward interest payment. And we did some episode before on Realty Coffee Talk on that. So this is why you have to look at them. You run the risk. And our trend is going down before it was going up. And borrowers may not be able to plan or forecast future cash flow due to changing rates. So if your interest rate is going up, it's very difficult to plan your budget, and you need to have money to pay for the bill. And this is where the challenges are when you are in a variable. So fixed rate, interest rate loans. So fixed rate loans are loans in which the interest rate charged on the loan will remain fixed for the period of time, term, no matter what market interest rates do. And this will result in your payments being the same over the entire term. When a fixed rate loan is better for you, you will depend on the interest rate environment when the loan is taken out and on the duration of the loan. So that means you feel comfortable that you have a fixed rate, you know your income, you already know your expenses, and you know how much money is going out, and you are plan it, everything is done, and you are paying it on a regular basis. Now, when a loan is fixed for its short term, it remains at the same prevailing market interest rate, plus or minus is a spread that is unique to the borrower. So sometimes you have other arrangements. Some people are even going second mortgages. And you have a blended mortgage. So it depends how you are doing it. But as long as it's fixed, you are okay. You can handle it. Generally speaking, if the interest rates are relatively low, but are about to increase, then it will be better to lock in your loan at the fixed rate. And this is what telling you when to lock in. If you have a low rate and they are going to increase quickly based on the market, based on the feedback from your broker, then you decide that you want to make sure that it is fixed rather than variable. Now, depending on the terms of your agreement, your interest rate on the new loan will stay the same, even if interest rates climb to higher levels. On the other hand, if interest rates are on the decline, then it would be better to have a variable rate. Because when it's going up, then you need to fix it. If it's going down, you will go to the variable. These are the options. And as interest rates fall, so the interest rate on your loan, your interest rate on the loan will fall also because of this. So what is the pros for the loan, fixed loan? Borrowers know exactly what their monthly payments are. And this is benefit to you. Regardless, the market rate changes. So that means you have a fixed obligation and you will be paying a fixed amount every month. The fixed rates do not rise during period of rising interest rates. So that means if you have committed, whatever rate that you have, the duration of the loan is fixed. It will not rise because interest rates are going up. Borrower can self-select their own time frame for many loans ranging from 6 months to 10 years, non-mortgage loans. It all depends what loans. You can negotiate any terms you want. Sorry, what happened? Okay, maybe something happened here. Okay, yeah. So the borrowers, okay, so you have a term that you can negotiate. Let's talk about fixed rate loan again. Those are pros, these are cons. Loans are less flexible under fixed rate agreement terms. That means there is no flexibility. Rates are fixed during the terms of the agreement. Now, fixed rates do not fall during period of declining interest rate. Let's assume you have a high rate and now the interest rates are going down. Your interest rate will not go down because you have fixed it. So this is what is very important to figure out and hire qualified professional to guide you how to set up your mortgage. And being a principal broker, Canada Express Mortgage, I can help you, and you can call us 905-785-9926, and I can direct you my team to help you to get the best mortgage. Now, fixed term fees may incur additional fees should the borrower want to change term or exit the loan early. And this is where it's important. If you want to change the terms of your agreement, let's assume you need some money to support your kids for higher education, and you want to break the term, or you get a second mortgage, they might want to blend it. And then you might have to do application and changes, or you may want to pay off your loan. You got a lottery, you want something, you want to pay off the whole loan. So then you have to exit the loan early, and there will be a consequence. We can explain that. So fixed rate loans have historically been more expensive over their life than variable rates. So it's expensive proposition for the fixed because the bank is taking, or the lender is taking the risk. So which is better? Which is better? The fixed interest rate or variable mortgage loan? Which one is better for each one? So borrower must consider the amortization period of a loan, because that also determines how much you pay. You want to pay off the loan, the longer amortization period, the greater the impact a change in interest rates will have on your payment. So not only interest, because you are taking a long period of time, also your monthly payment will also be affected, because then you have a longer period, you have a short payment, you have a short monthly payment or less monthly payment. The determination whether a fixed or variable rate is better depends on the borrower's financial profile and preferences. This is very important. You are the one who's going to borrow the money, and you have to know what you want to do. And this is very, very critical for you to pay attention and maintain your financial record properly. And we're going to talk about that towards the end. So begin by assessing your cash flow. How much money is coming in, how much money you are spending, how much is you have a saving after paying all the expenses. Financial flexibility, how much flexibility you have when you are acquiring a property or refinancing your existing home. And need for security. So bank always, or lender, will need the security. Security is your equity in the house. And that's the basis for borrowing money against the property. Not every person will be in the same situation. It goes one person to the other person. And the variety of financial loans product can cater whatever is best for the borrower. So when you come to a broker, we look at all the options we have. We have a lender, B lender, private lender. We will look at every scenario to make sure we are able to secure funds. And obviously, there will be fees that you have to pay depending on what you're doing. And this is why we're disclosing this to you. So there are other factors to consider when deciding on the type of rate to pursue. Interest rate, trends, and forecasts. In general, if you think interest rates are going up, look into a fixed rate agreement in favor, at least in the short term. If you think interest rates are going down, a variable rate agreement is ideal in the short term. So this is the trend you have to watch. Going up or going down, and then you determine. Interest rate spread. Sometimes you may want one type of loan, but it's so much more expensive than the other. Always look at the terms of the both. Or you may be inclined to pursue only one. The difference between the terms for a fixed loan versus a variable loan may sway you one way or the other. And because it's very, very important, when you come to us, we will explain you how much it's going to cost, what are the risks, and how long and how much you qualify after giving the information. Long term, though nobody knows what long-term economic conditions entails, because you may base your decision on short-term condition if you do not expect to have the debt for a long period. So depending on the resources, financing condition that you have some side income coming and you are able to pay off some big loans, it all depends what how long that you are able to have a condition that you need to borrow the money. Though this concept of fixed and variable is integral to buying a home, these terms are also available on such shorter debt. Basically, it's all economic. There are multiple things: employment, job, and market condition. Depends. You are a self-employee, you are a payroll employee, you are executive, method of income, you have a good income, you pay taxes. So many, many elements involved. And then we're talking at long term, how long the term will be, 3 years, 2 years, 5 years. And this is the debate you have to make with your mortgage broker. And you can call us, we can more than happy to help you. Third, anticipated personal income forecasting, because when you are borrowing a loan, it is based on certain assumption that you have a job, you can continue to have a job, you're expecting a pay raise, and you want to build a second dwelling unit at the property, or you're going to do something else. You have to have a budget. So the decision around fixed or variable rate centers around the need for security. Because when you borrow the money, the lender will want security before they give you the money. We have to evaluate income situation, including job stability, prospective salary growth, and current saving. So you have job stability, you have a regular job, and salary growth. That means you're projecting that if you're going to go 5 years, we expect to have a growth in your job, and obviously your salary will go up, and you have more money coming and saving that you have. If you project higher income in the future, the risk of variable rates decreases as you anticipate having more disposable income to counter rising expenses. And this is anticipation of personal income forecasting. And an interest rate differential, which is the difference between the interest rate on your mortgage contract and the interest rate the lender is currently offering on mortgages. So when you are terminating an existing mortgage, I want you to understand, I'm going to give you an example of that. This is why I did this, so you understand that. The interest rate differential, that when you terminate, there's two things. When you have a contract, there is a rate there. And when you are terminating an agreement or refinancing it, and you have a number of years or months remaining, and the bank is offering you current rate for that category, is it 2 years, 3 years, whatever is remaining on your period on your mortgage, and that will be used. So the interest rate reduction differential is primarily used to calculate the penalty a lender charges a homeowner if they break their mortgage before their mortgage term ends or the maturity date. And this is where I put in red so you know it. and you can watch it later on when we put it on YouTube, okay? So IRD calculation only applies to closed mortgage only, not to the variable mortgage. These mortgages allow you to lock in a fixed rate for the duration of the mortgage term. They also prohibit you, when you have a fixed amount, fixed mortgage, they also prohibit you from contributing additional payment on top of your regular mortgage payment schedule, because they will lose money. Everything you pay will go toward principal. So you have to look and see what agreement you're signing. Banks include a break penalty in mortgage contracts to dissuade borrowers from paying off their mortgage early or refinancing it, because they will lose business. And this is why it's very, very important. Understand? So now interest rate differential. This is very, very critical. I'm telling you, the penalty could be 3 times than normal payment. And I'm going to show you calculation also, example for that. And you have to calculate the same way what your calculations are. Since the primary source of revenue for banks come from the interest collected on the loans issued, it is not in their best interest to have homeowner paying off mortgages ahead of the schedule. They don't want you to do that. They don't want you to pay. But if you calculate a mortgage, right now you're paying higher rate and you have, let's say, 3 years left. And if even paying a differential, interest rate differential, you still will save money. If you refinancing it, then you need to have a calculation in your hand and then you go ahead. You're still saving money. But if there is no benefit of saving money, then don't do it. The longer a mortgage remains outstanding, the longer interest revenue is collected. So that's how the bank wants to keep taking the money from you. And this is very, very important for you to know. Should a homeowner decide to break their mortgage, whatever God reason, they have to sell the house, whatever reason, to support the family member, they have to sell it. And the break penalty helps offset the lost interest revenue. So this penalty will help the bank or the lender to offset the loss in interest because they're losing interest. Now, penalty calculation, 3-month calculation. We're going to say 3-month interest penalty versus interest rate differential penalty. There's a two difference. One is variable, one is a fixed. So we're going to do the calculation toward the end. We're getting there, and I will show you. The state standard break penalty for the mortgage in Canada is higher of the IRD or 3 months interest. The primary difference between the two penalty is how the lender determines the amount you must pay. To calculate IRD, lender obtain the difference between the rate on the mortgage, on the current mortgage contract, and the rate they are currently assigning to new mortgages they issue. Then they multiply the difference between the two rates by your existing mortgage principal and divide it by 12 to figure out the fee. Then they multiply this fee by the number of months remaining in your mortgage term, which works out to be IRD you're obligated to pay. So 3-month interest penalty is more straightforward to figure out. This is the standard variable interest rate penalty to terminate a mortgage. So 3-month interest penalty is more straightforward to figure out. It consists of charges equivalent to 3 months worth of interest on your existing mortgage. If you go to your bank online, and they will break down how much is the principal, how much is the interest, and total payment withdrawn from your account. So they will show you right online, and you can check any bank. And that is times the 3 interest payment, not the principal. Keep in mind that the above calculations are a general rule. Each lender has a unique policy that outlines how IRD is to be determined by them. So each one has his own procedure. Idea is to increase awareness that you know this is going to happen. The big 5 banks, for example, tend to be more punitive when it comes to the IRD than non-bank lenders. Your specific mortgage product, remaining term length, and repayment size are also crucial factors that can affect the IRD calculation. I did a calculation for both at the end, so you know why we're doing it. So you have an idea. So 3-month interest penalty. This is a regular penalty. I'm giving you a formula, then you can see that, and then you can calculate your own. So this is, let's say you have a variable mortgage. It's about principal right now is $350,000 and interest rate is 4.25. Okay. And the interest rate you pay in a month is this much based on that. It's just an example of that. So you have a $350,000 remaining times the rate, let's say 4.25 divided by 12 is $1,239.59 per month. Interest only, not the principal. Now you have to pay 3 months. It's a variable, so you multiply with 3, and that is your amount. And that's a variable. You don't pay any other penalty. Now we're going to calculate interest rate IRD. Principal amount, again, we use the same principle, 350,000, the rate is 4.25, and we have 5-year term, but we have only 33 months left, or a 30 month, it should be 30 months left. And say 3 years remaining, okay? So current 3 years mortgage rate is 3%, whereas you have a 4.25. So you subtract that from the current rate, and your differential rate is 1.25. And now 1.25 you multiply with the amount, 350,000, multiply by 1.25 divided by 12, that give you 12 payments. Then you multiply that with 33 months. In this case, we just repeated 33 months. I think it's 30 months, but maybe I put 33. So you multiply that number of months remaining, and that's your penalty with IRD. So here's my card. I'm a principal broker of Canada Express Mortgage Inc. We do residential, commercial, and construction loans. And we have equity financing, reverse mortgage, and co-buying also available through our brokerage. There's a license, there's my contact, and you can apply online. And these are our services. We do purchase financing, equity financing, refinancing, reverse mortgage, construction loan, alternate private lending solutions. I'm a principal broker of Canada Express Mortgage Inc. My license number is MO8003120. And we can provide you can go online, you can apply online. Everything goes to our mortgage origination program. Thank you for watching, and I hope that you like the program. And I'm going to stop sharing. And the recording of this program will be uploaded to YouTube channel. So I would like you to go to realtycoffeetalk.com, or you can go to YouTube at the rate of Mortgage Coffee Talk or Realty Coffee Talk, and you can watch this episode and provide us feedback, what you think about it, and we really appreciate your feedback. And we continue to produce this program. So mortgage program will be broadcast next month, second month, on Wednesday at 7 p.m. And unless we have a request coming from a consumer or professional to do early. Thank you for watching. May God bless you all. May God bless Canada. Bye for now. Thank you.